Uh,
Cool.
cool. All right.
We can edit this too. So.
Okay.
All right, you ready?
Yes.
Cool. Hey, Julian, I am so excited to interview you for our 2022 State of the Industry Halftime Report. For everyone watching, we are gathering the top experts in the industry to get their insights on what the realities are in the market, what we can expect in terms of trends, and what we can look for in terms of opportunities. And Julian is absolutely the best. He is a very well-known speaker, consultant, and the founder of the Basis Point. So Julian, thank you so much for joining.
Absolutely. Glad to be here. And of course, you and I are going to have fun because it's been a little while since you and I have done this together. So I'm excited. I
know. I am so excited. This is my favorite thing, to get your thoughts on what's happening in the market and with consumers today. So let's kick it off with the first question, which is what are the top 3 or a few realities or major data points that you believe are driving the market right now?
Sure. Yeah. And for what it's worth, I don't know how you want to do this, but I can do 3 real fast. And then each one of them has a little bit of a rabbit hole that we could go down if you want to. But yeah, I think that, you know, for those that follow anything that I like to keep an eye on, it's fintech's role in all market trends. So the first one I would say that I am watching very, very closely is fintech's role in the home equity era. And we could put some stats around the home equity trend that's starting to build up and play out here. But number 2, I would say, is loan officer movement between banks and non-banks. Because if you look closely at that data, you've got a lot of migration that has happened during the 20 and 21 phase. And I think as 22 matures, it's only really this month that all firms, banks and non-banks, are like, oh, okay, this market adjustment is very real. And it got very real this past month for folks. And that's when you start to see folks moving around. And then number 3 is the growing importance of fintech in regulation and policy making, because there's some very material things going on with regulators. And frankly, a warming that I'm observing to fintech that I hope that observation is right. So if you want to unpack any of those, we can unpack all 3, I'd be happy to.
Yeah. I would love to. And let's start with your first one on the growing or the equity conversation.
Yeah, sure. So I think lots of folks follow this stuff pretty closely, but here's some stuff that's very, very fresh, which is tappable equity, which is a great stat that Black Knight keeps track of. And for those that don't follow it super closely, there is a nuance with tappable equity. It's not just total, it's not just LTV stuff. It's actually LTV up to a cap of 80, meaning tappable equity is all equity up to an 80 CLTV, which actually keeps the market systemically safe. And so when we talk about equity extraction in this era, if you use the tappable equity number, you're doing so in a much more responsible framework than happened in the previous cycle, where it was just all about tapping equity, and home prices were also at a peak in the last era. We know what was going on with very flimsy underwriting, but it just wasn't real. So I do like that nuance around referring to equity as tappable equity up to 80 CLTV. But it's like this, it's grown 78% pre-pandemic to present. So at the end of 2019, it was 6.12 trillion in tappable equity. And now as of the first quarter 22, it's 11 trillion in equity. 75% of that equity is held by folks with first lien rates of 4% or less. So the obvious play there then is folks aren't really going to be touching 75% of refis in the first quarter were actually cash out. But I think that that's on the wane for sure. And I think more folks are going to be like, I think I'm going to keep my 4% or below rate. And what am I going to do if I need equity, either because I'm staying here or I potentially want it as optionality to be able to write cash-like offers on, say, second home investor, or potentially just doing it as a sort of a bridge to a new property, right? Mm-hmm. So how do you do that? In my opinion, it's all about valuation. It's all about systemic responsibility. And there are kind of two ways that goes. It's human or automated appraisals, right? And you can't do equity in any meaningful way. The barriers to second lien home equity extraction were always about slowness on valuation. Customers are like, yeah, no, I don't want to do that. So the fintech era that kind of started happening was like home equity loans. I won't name names, but I will name some like digital banks that were offering home equity loans that when you peel back the layers and actually, my team had done some calling to sort of see what would happen if you call certain digital bank offering a home equity loan. It turns out it wasn't secured by the property. And that's flawed for two reasons. One, because it's basically a personal loan, and it doesn't really kind of go to the core of what people are trying to do, which is tap this existing asset that they have. And two, those rates are higher because if it's a personal loan, it behaves like a personal loan, and those rates are well above whatever prime plus any HELOC margin would be, right? Mm-hmm. But if we look at the prime rate today, and even the prime rate at if you account for anticipated Fed funds moves as the Fed continues to hike rates, those are still going to be, we're in this unbelievable window right now where prime plus a 0 to say 1% margin is still below an average 30-year fixed rate today. It's insane. So it's the math works for consumers. It's all about how quickly can I get it done? And to me, that goes to automated valuation, right? So who are the automated valuation players that have street cred on Wall Street to where if I'm a lender and I can use the right automated valuation tools, is that offer I'm making actionable, or do I have to get an appraiser out there or not?
And that kind of leads us into the third point that you talked about, is that our, regulations or the regulatory environment changing to adopt some of those types of, or accepting some of those types of technologies available.
I want to share a quote on that note from CFPB Director Rohit Chopra, because he spoke, as you know, to the MBA secondary conference a couple of weeks ago. And he said the following, like, the future isn't human versus machine on home values. It's when you use which. Mm-hmm. As a regulator, of course, he didn't offer explicit notes about what their stance is. We know that appraisal waivers have become a very welcome trend. If we see home prices start to come down in any material way, right now, we got Case Shiller this week, depending on when anyone's digesting this material, I'm referring to May 31st is when Case Shiller came out. And as we know, that data can go back 3 to 4 months. So it was all-time record again, but it's backward looking. As that data starts to catch up, we are going to see some slowing on appreciation. The MBA thinks that we're going to go from approximately 17% home price appreciation last year to more like 6% this year for the year. Mm-hmm. And if that happens, I don't anticipate that appraisal waivers would go away, because there's still so much equity, and we're not reverting on home prices declining. But the second that home prices decline, automated valuations come under risk. But until then, Wall Street and therefore regulators, I think, are really supportive of it. And remember, this home equity lines of credit are within a more of a Wall Street rather than, say, a Fannie Freddie kind of a framework. And so there is, we'll use House Canary as an example of an automated valuation machine that is widely used on Wall Street to buy homes and loans. So they're already familiar with its accuracy. And as more and more lenders start to kind of think about these ideas of how do we use automated valuation to make HELOCs go faster, that's like one case study that I think is notable and watchable in terms of making the HELOC era viable and fast and modern. But of course, yes, if home prices reverse, automated starts to become less attractive to Wall Street. I would add one note here. The one thing we're also watching really, really closely is whether non-banks have a play, if I can be blunt, because banks have balance sheets and therefore can do HELOCs a little bit more easily. Non-banks have to have a takeout. And so there are plenty of options there, but it is who's going to get the market share is what we're kind of watching for. Is it going to be the banks or is it going to be the non-banks? Because it's like super easy, automated valuation. And granted, maybe it has a bigger margin because there is a little bit of a price premium on it. But as long as it's not coming up to some margin that's exceeding what, say, in our previous digital bank example that's non-securitized to the rate of, say, what a personal loan would be, I think it's very competitive.
So that definitely leads us into the next section where we're going to talk about opportunities and trends. But before we do that, I was looking at a graph recently that showed the home price to income ratio is higher than it was even in the housing bubble and historically high rate. Is there any kind of concern as we're talking about, what you're talking about here? Is there a concern that is overextended?
In short, yes. And the data is just now starting to come in for the first quarter, which fully reflects this going from 3% in December on a 30-year to, let's call it 5.25% now, right? And if you look at certain metrics, you're talking about the idea of monthly payments being as much as $600 a month higher. And if you start cascading that into DTIs, it has material impact on DTIs. There's not enough data in yet in terms of the data that we like to follow around DTI that I will comment on this on our next interview, more specifically about what it does to DTI. But we did some modeling during the first quarter about where we left off on DTI for first-time buyers in 4Q versus if you account for a full 20% home appreciation on the year in 22, meaning a full 5% in Q1 and the full 2.25% on rates. And we were calculating that you would go up to, and this is just coincidence, approximately 43% DTI. That was just some modeling that we were doing throughout the first quarter. If that holds, that would be wonderful. If it ticks above that, you still have some breathing room there with respect to Fannie and Freddie AUS allowing up to 50%, right? And then the rest is who, yes, there's no question that certain folks get to a place where they can't afford it. I would offer this. Most of the affordability headlines and metrics, though, and this is the part that gets a little frustrating and why I think it's really worth underlining. If you look at the percentages of the DTIs that comprise almost every affordability, or in this case, unaffordable headline that hits every consumer in this country every single day right now, and then they go to their loan officers, and even loan officers and whole lending institutions are like, oh my God, you want to capitulate in a way, but it's like this. Most of those are predicated on these DTIs that are somewhere in the neighborhood of like 28%. And that's just not how loans are approved in this country. So my advice to consumers is you have to take your advice from lenders and not the media.
Yeah.
And to the lenders, you can't capitulate. You have to remember, no matter how tired you are, that you have to keep redoing those pre-approvals and you have to keep talking to people about how loans are actually made and what is actually comprised in a DTI and how DTI is calculated, and taking them through that over and over again. That's just the good old-fashioned ground game in a purchase market of helping people understand what they can do, because I do not agree with the headlines because they're based on data that is, just so materially below what is allowed by our main regulator, FHFA.
Yeah. Well, I definitely think people are listening to the media and people around them and not listening to lenders from a consumer perspective. But
Yes.
also, I mean, I don't think there's enough affordable units available or multifamily units available for the demand. And so that, of course, is going to drive up that ratio too. So I think
I do agree. And I'm speaking from a perspective that is to our lender community,
yeah.
that is there to meet a market need. And if we look at the data, here's what's encouraging for the lender community. 4.8 million purchase units last year. We're projected to do, even with the revision down on the most recent May revision, 4.5 million purchase units this year. So if the function of the lending community that we are that's so close to home for us, and we're there to serve the consumers, the market need is still very, very similar to what it was last year, albeit with less refis. The purchase market need is still there, and we have to meet that need. And the only way to do that is to keep the education on high. And Kristen, obviously, you're like one of the quintessential financial literacy educators out there. So this message is really important of like DTI all day. That's the name of the game. This is not something that consumers that feel defeated read about, and it's up to us to make them read about it.
Completely. And I mean, I talk about this a lot, but a lot of consumers feel a lot of anxiety and they don't understand it. It's not just that they don't have the information. It's that they're also just feeling the pressure from the media and what they're hearing around them. I felt that, and I know the right information, but
Right.
Buying a home a year ago, I felt like, oh, this isn't a good idea. And I really had to look at the data to make a good decision because that was logical, so.
And better than anyone, like financial literacy and education is the key to, like, I advised consumers for so many years, all day, every day. And there's no better feeling than watching the lights go on for somebody where they're like, oh, I see now, because everyone does the same thing. Everyone's like, I don't know. I mean, I spend this much on coffee and I don't want to stop doing that. And I want to, I don't want to kind of adjust all of these other sort of like just creature comforts that make for like a basic enjoyable human existence day to day while I'm trying to like achieve the big financial goal. And we are in block and tackle mode this year in a purchase market where DTI all day long. What is a front ratio and what is a back ratio? Housing only, and then housing plus all other debt that gets calculated to let them understand this is how much of a percentage you're spending on housing only, but this one is the one that matters. Housing plus all your other obligations is this percent of your income. And once people start understanding that, all these headlines wash away.
Mm-hmm. Absolutely. Well, you are one of the best people I know, smartest people I know when it comes to predicting trends and keeping an eye out for what's coming in the industry. I would love for you to talk about, and you've touched on a lot of these trends so far, but are there any other trends that you would say or opportunities that you're seeing coming up in the industry?
Well, let me do these other two just really fast, because I think it's really interesting to talk about loan officers moving around, and also again, hopefully what might be a warming stance on fintech and regulation. Okay,
let's do it. Yeah.
So on the loan officers moving around, this is, again, I would start with a couple core premises. First, our industry isn't a growth industry. Even like, let's set aside 20 and 21. It's not a growth industry per se. It's just this giant $2 to $2.5 trillion a year originations industry, plus a $12 trillion-ish servicing industry. And market share does just move around, especially in originations. What do we mean by that? It means that where the originations are happening are moving around. There's this big $2.5 trillion machine, and who's producing those loans, it just moves around. Okay. So what's super interesting to me is that market strain makes LOs move, and customers are loyal as long as you have the best price and product. This is like the harsh reality. You can talk about loyalty all day, but they're loyal to price and product. And this in turn applies to loan officers. Okay. Because if the consumers are pressuring the loan officers the loan officers have to go where they can serve their consumers. So that's why market strain causes movement. Okay. So I want to give some examples. Say it again. Sorry.
Can I say something? So I want to push back a little bit because I do feel like because I'm curious about customer loyalty. This is something that I think a lot of
harsh statement,
really,
I know.
really struggle with, because I honestly, I mean, I look at distrust in the market. That's one of the big areas I focus my research on. And I am focused on the next gen population, but there's just so much growing distrust. I mean, 2 in 3 next gen home buyers said that they didn't find lenders trustworthy or reliable. And the greater market is distrusting financial institutions, government institutions, faith-based, across the board, not just financial. But I think that when you are able to establish trust, it does create loyalty, whether or not you're looking. I agree with, I mean, if it's like a huge difference in rate or product, then you go somewhere else. But would you not say that this is a component of that? Or
let me take it one level. Based on that push, which is a good push, I would take it one level further and maybe create a different sort of controversial statement, which is, if you take what you said and apply it to what I said, there is loyalty, and it's to the loan officer more than the company.
100%. Yeah.
So that does create a little bit of controversy coming out of my mouth, because then companies are like, loan officers are like, yeah. And companies are like, dude, why are you saying that?
Okay,
and let me say to all the companies, brands matter. Okay.
Yeah.
Period. We all know this, but in a predominantly retail world, and if we are talking about education and trust and building that trust, which then leads to the loyalty, then the whole idea does become, when the market is strained, no matter how good I am as an LO, if I don't have product and price to deliver on my excellent advice, sometimes that market strain means, oh my gosh, I might have to change horses, and it does happen. So that I think reconciles the two stances a little bit.
Yeah, that makes sense.
Less harshly. But let me give you some stats from our friends at Ingenious, and I'll do this very, very quickly. Between 20 and 20 combined, 20 and 21, just using one example, the largest depository lender across those 2 years gained 3.84 billion in new production from loan officers coming over from 2 other top depositories. They lost 7.5 billion to 2 top non-banks. So that's a really interesting example. So let's just focus on a major depository in those 2 years losing material production to non-banks. Just two in that example, right? But 7.5 billion to 2 non-banks alone. The stats go deeper than that, but it makes the point.
Wow.
With that said, it tells us a couple things. Lots of bank volume went to non-banks during the refi boom, mostly because of pricing. Okay. So sorry. And then can we adjust that?
Oh, we're good. We're good.
Or not. Yeah.
This is life.
That's like
I like to see real life
there.
happening in this conversation. So it's good.
But the non-banks did really much better on pricing for refis, and that's a big reason I think that happened. Purchase isn't just about price, though. Going back to some of your points, it's about cash-like pre-approvals, aka TBD approvals, and banks are going to be sharper on pricing, especially jumbos. So what I'm looking for is to see how many folks that went to non-banks go back to banks, especially in high-price markets. In a purchase market where I need the bank balance sheet again to win all the purchase business. But then for the non-bank side of things, I think non-banks crush it on TBD approvals. And that is a really tough model, but that's what gets deals done in the bidding war environment, which is poised to continue.
Yeah.
So I think that banks and non-banks still have very strong value props, respectively. but those are the trends that I'm watching for on that loan officer migration. But
Okay. Yeah, that's fascinating.
every meaningful loan team I know is exploring options right now, because that's what happens during times of market strain.
Yeah, absolutely. I'm definitely hearing and seeing that. So I want to hear from you, and I could talk to you for hours, but I would like to move into talking about opportunities or strategies that you see coming out of this, especially over the next 6 months or so.
So I think the opportunities and strategies are we've covered some of them, because to me, everything is just a good old fashioned ground game. There is no fancy talk around a market like this. It is like being in the faces of your realtors and old school tactics of like, you're showing up, you're doing your builder deals, and you're sitting there in builder offices, in sales offices on new projects all day, every day with those sales teams, and you're suffering through it with them if traffic is low or high. That's who get on the lending side. The ones that are hanging in with the people selling the units, whether builder or realtor, are the ones that get the deals. And yes, digital marketing absolutely matters, but so much of it is straight up ground game. And I cannot emphasize enough the idea of like, how sharp is your pre-approval, AKA TBD approval package and plan and program. That starts with ops within your mortgage lending institution, but then the rest is, how are you marketing it? All the semantics around a pre-approval is not really a pre-approval are all hot again. And we've been talking about this stuff for years, but everyone who knows like the real like bruising kind of bare knuckle purchase market stuff, that's what it's about. And it's like, there is a difference between, I talked to my new prospect, Kristen, for 30 minutes, and she's got a clean profile and a good credit score. And I issued a pre-approval letter, and then she writes an offer and she gets accepted. And I didn't look that she has self-employment income, and guess how she's handling that on her tax returns. It's showing as a loss, because that's how she does her taxes, because it works better from a tax standpoint, but it screws up my DTI. That stuff is the down in the trenches stuff on TBD approvals, that you got to do all the work up front. You got to suffer through however many offers in that example Kristen's going to make. And you got to do that every time, month after month. And there's no secrets, man. That's the opportunity. The opportunity is like, you're tired from the refi boom, and sleep fast, because now you got to work harder.
Yeah, definitely. We're hearing that across the board. And I think of you as, a digital mortgage guy. You are always on top of tech trends. Do you have anything, to share in terms of fintech or, what's cutting edge that or at least that you're seeing lenders adopt right now?
I think there's two things going on with respect to lenders and fintech right now. One is we have a little bit more time to work on strategy, and two, budgets are tightening very, very quickly. So some firms do, in cycles like this, lean into fintech and say, okay, here are a few kind of strategies that got tabled for the last few years that we are budgeted for and we're going to do. And others are like, you know what? We're going to go slim, and we're not going to lean in as much. So there's going to be a thinning of the herd on certain more crowded parts of different categories of the fintech sector. But there's the category leaders, I think, can do very well in this moment if they can demonstrate street credibility, because we know that sometimes category leaders, especially in a long, successful cycle, can say, well, we don't necessarily, on our roadmap, this functionality that you've been asking for is really far out. This would be the time that I would advise the category leading fintechs to say, do what your lenders want, because this is when you make those relationships last for the next 10 years. If you get through the next two, you are the enterprise software for those partners. So that's my advice to the fintechs, and my advice to the lenders is choose your spots. There are many shiny objects. There always will be, but tighter budgets force you to make smarter decisions. And when you reconcile those two stances, all the options are there that lenders need, but it is a little tougher to make smart lender decisions when you're in a time of austerity.
Yeah, I 100% agree. And I'm, as someone who represents the fintech side of things, I am seeing people that are kind of locking down and others who are investing from the refi boom into some of these categories. But I think that lenders that are investing in the kind of technology that's going to support their realtor or builder relationships and technology that's going to support the financial literacy side of or engagement with their customers, the things that you've talked about, like making that kind of awareness known and
Yes.
building those relationships, building the trust, that's going to make a big difference. And I think that lenders that are, it's understandable to slim down, tighten up. But I do think doubling down on some of those efforts is going to make a difference in this kind of market that you're talking about. So.
I couldn't agree more. You have to have, it just goes back to our first topic. If you aren't getting that education down, and you have to be the media, and being the media means that you got to do it over and over, and you have to find smart ways to automate your best messaging and your best education. Mm-hmm. And if you don't do that, all these headlines are going to continue to outweigh you.
Yeah, absolutely. Well, Julian, I could talk to you forever. I don't want this to end, but likewise. Thank you so much for taking the time. Is there anything else you'd like to share before we close out?
I'll tease something for the next time, which is that some of these, this convergence of the policy-making regulatory environment and a maturing fintech sector, I see some signals that I'm very optimistic about. Again, unlike so many headlines that are like either regulators don't get fintech or fintech, is running afoul of policy. I think that regulators do get fintech, and fintech is rapidly getting sophisticated enough to understand what's required to do it right. And we're approaching a really, I think, productive era there, which we'll do next time.
Absolutely. Well, I can't wait. Thanks again, Julian. So great to see you. And
absolutely.
Yeah, appreciate your time.
Yes, absolutely. See ya.
Right. See ya.
So I screwed up with